The breadth, though, has been amazingly selective, very selective, in fact. Now, the NASDAQ is strongest today, but the number of 52-week highs over the last few sessions has continued to decline. Overall advances coming into the session were really dropping a lot. So what to make of this? It's a conundrum of sorts, right? You've got a strong market, and yet many ways it's also a weak market. I want to ask Key Advisor Group CEO Eddie Gabor, along with Keith Fitzgerald, Group Principal Keith Fitzgerald, and Gibbs Wealth Management's President Aaron Gibbs. Aaron, let me start with you. So the market breadth, has been extraordinarily robust, right? Particularly the number of winners, though in the last few sessions, that's come down a lot. Of course, 52-week highs have come down a lot, even as we see big moves on the market. What is this message? What is it telling you?
Yeah, well, when you look at what's really going on in the NASDAQ and you look at like equal weights versus the large cap weights, we've seen a little less participation from those smaller stocks since about the last week of January. And it's really the recent highs have been driven by these mega caps, specifically the Google and the Tesla. And so if we really want to see this move forward and upward, one, we'd like to see a better breadth of smaller caps, but we know that there is a waning of infatuation with the mega caps, and those stocks are becoming fewer and fewer. Amazon's gotten knocked out, Facebook's gotten knocked out, and so you've got to be concerned that if these megas aren't going to be the drivers pushing these new highs, we've got to rely on those smaller caps, and so that's what we need to see: are strong reports, better economic activity, so on and so on.
Keith, away from the NASDAQ and the mega cap names, today the biggest winner by far in the S&P 500 are financials. Maybe they're starting to live up to the hype, but it continues. You just can't throw a dart. Now, I think a lot of people look and see, wow, the market's at all-time highs again. You just can't throw a dart, though, and pick a winner, can you?
I gotta respectfully disagree. I think that's exactly what you can do right now. It's not hard to figure out. For example, Charles, something you and I always talk about, digitalization is the greatest single trend in mankind's recorded history. So companies like Apple, companies like Visa, for example, are taking a piece of everything. It's very hard to lose in a scenario like that. It's picks and shovels all the way.
So you're just saying, no, stick with the winners then. I'm saying out of the broad market, last year, 40% of the S&P 500 was down, and more are down so far this year, Eddie. And so what I'm saying is that if you're looking from afar, okay, is that your only choice? Just chase the winners?
No, look, I think we're going to have this continued rotation into the discretionary names. Look, we've told our clients that the reflation trade is where you want to be. We expect oil prices to continue to go up. We expect the 10-year to continue to rise. And so you want to be in discretionary names, energy names, commodities. And I think those are going to lead the way the rest of this next 2 quarters in conjunction with small caps. So what didn't work last year, we think will work this year. And so far, it's been a pretty profitable move for clients.
All right, so you brought up the yield curve certainly steepening a lot, the 5 and 30 at the widest gap, I think, since 2016. And that, of course, does mean there are certain stocks, certain sectors that benefit big time, particularly as we see a rise in inflation. So, Aaron, are there certain names that individuals should look at pegged to the steepening yield curve, the increase in inflation, because we know they specifically help some sectors more than others?
Yeah, so the obvious is banks, and specifically those banks that use those spreads in order to make money. So companies that rely on deposits and mortgages. And so I think one of the easiest way is regional banks. And again, I would recommend more of an overall regional bank ETF versus doing any specific, because you know that they're going to benefit across the board as they're able to make money off of those spreads. So I think that would be by far your safest bet as we're looking at a more reasonable yield curve these days.
All right, so my stock of the day is Best Buy, and the reason I say it is actually the survivor of the day too. I know everyone remembers when it was being written off. The stock was a showroom; they were going out of business. Everyone was buying everything on the internet. Since then, it's been a juggernaut. I mean, the stock has been a rocket ship and even got a new upgrade again today from Bank of America. So my question, and I want to go to you on this, Keith, any kind of beaten down names, right? We're talking about chasing. We're talking momentum. A lot of investors are just reluctant. They're saying, is there a beaten down name? It doesn't have to go up tomorrow, but has a chance perhaps over the next year to really come on big time.
I tell you what, I think that Pfizer, and we don't normally think about it this way, but I think Pfizer is undeniably beaten down. People don't understand COVID. They think we're going to beat it, but in fact, it's going to be an ongoing source of revenue for that company for years. It's also shed legacy businesses. So I think it's going to return to 8, 10, 12% a year growth because it's going to be focused on innovation and moving forward. So it's not a tech play, not usually what I would consider dumpster diving, but I think a great play and a healthy dividend to boot.
Eddie?
I'm going to go a little bit more speculative. Look, I think the airlines are going to have a good 12 months because I think we're underestimating the pent-up demand. It's not for every investor, but I think now's the time to be adding some risk to portfolios. And so when you look at the MGMs, the Spirit Airlines of the world, again, I think there's a tremendous amount of upside. They're still down quite a bit over 12 months. And so having some exposure to that space for some of the fastest GDP growth we're going to see in the next 2 quarters, I think you'll be handsomely rewarded.
You know, Aaron, I know that you don't really specialize in that niche, that kind of thing, but, you know, we talked about reopening trade, stay-at-home trade, reopening trade, stay-at-home trade. Where are you now in terms of that divide?
I think, you know, we're going through some sort of temperament as we realize that reopening is going to take longer than we expected, considering how long the vaccination is going to take. But I'm still very positive at looking at massive GDP growth or significant GDP growth in 2021. And so I'm more towards reopening. I think investors are really looking 18 months out. And so we want to look at companies that are going to be able to take advantage of that reopening and pent-up demand. Right. And so, again, like I said, small caps and travel, entertainment, all are going to be winners. Moving away from the home.
There's some beaten down names in there, right? I mean, the cruise lines, for instance, come to mind. I mean, 18 months from now, I think our Norwegian cruise line will be a lot higher.